Imagine you own a company. You need £100 million. Maybe you want to buy another company. Maybe you want to build new factories. Maybe you simply need to refinance a loan that is about to mature. So you go to a bank. The bank studies your business, checks your accounts, analyzes your risk, and decides whether to lend you the money. But what if the bank says no? You might think the story ends there, but it doesn't. Because over the last decade, a completely different financial system has quietly grown around the banks. A system where companies can borrow billions of pounds from investment funds, pension funds, insurance companies, and wealthy investors. No high street branch, no public bond market, and often very little information available to the public. This is private credit, and globally, it has grown into a market worth more than $2 trillion. But the most important question is not how big it has become. The question is, what happens when the companies borrowing this money need to repay it, and the investors who own the debt suddenly want their money back? Because this is where the story becomes much bigger than private credit. It becomes a story about banks, pension funds, insurance companies, British businesses, and a financial system that regulators themselves are now stress testing. Before 2008, if a large company wanted to borrow money, the banking system was usually at the center of the process. Banks collected deposits, banks made loans, and banks carried much of the risk. Then the financial crisis happened. Banks lost billions. Governments had to rescue parts of the financial system. And regulators responded by making traditional banks more heavily regulated. Banks were required to hold more capital. They faced stricter lending rules, and some types of corporate lending became less attractive. This created a gap. Companies still needed money, but traditional banks were no longer willing to lend as freely as before. And into that gap stepped private funds. The basic idea was simple. Instead of borrowing from a bank, a company could borrow directly from an investment fund. The fund would collect money from large investors. Then it would lend that money directly to companies. For the company, this could be faster and more flexible than a traditional bank loan. For the investor, the attraction was even simpler: higher returns. And for years, this looked like a perfect deal. Let's use a simple example. Imagine a private equity firm buys a company for £500 million. But it doesn't pay the entire £500 million with its own money. Instead, it puts in £200 million of equity and borrows the remaining £300 million. This is leverage. Now, imagine that the £300 million loan comes from a private credit fund. The company must now pay interest on that debt. If business grows, everything can look fine. Revenue increases, the company becomes more valuable. The private equity owner can eventually sell it for a profit, and the private credit fund collects interest. Everyone appears to win. But debt creates a very important condition. The company does not simply need to be profitable. It needs to generate enough cash to keep paying the interest, and eventually the loan itself may need to be refinanced. This is where the system becomes vulnerable, because the company may have borrowed money when interest rates were low. But when the loan matures, the cost of borrowing may be much higher. A business that could comfortably pay £10 million in annual interest may suddenly have to pay £20 million. And if the business cannot afford that, it needs a new loan. But what if nobody wants to provide one? This is the problem with debt. It doesn't disappear when the economy slows down. In fact, the opposite happens. When the economy weakens, company revenues can fall. Interest payments remain. Refinancing becomes more expensive, and investors become more cautious. The companies that looked perfectly healthy during good times can suddenly look much more fragile. But there is another problem. Private credit is not traded like a normal stock. If you own shares in a public company, you can usually sell them within seconds. But a private loan is different. It may be worth hundreds of millions of pounds, but there may be no easy buyer waiting to purchase it. This creates a strange situation. An investment fund may own billions of pounds in loans. On paper, those loans may still be worth almost exactly what they were worth yesterday. But if investors suddenly want their money back, the fund cannot simply press a button and sell everything. The assets are illiquid. And that creates a mismatch. Investors may want cash today, but the loans may not be repayable for years.
This is one of the reasons regulators are paying attention. The Bank of England has launched a major exercise focused specifically on private markets.
The goal is not to predict a crash. The bank has been very clear that its scenario is hypothetical. Instead, it wants to understand what could happen if a severe global downturn hit the system. How would private credit funds react? How would private equity firms react? How would banks react? And could their individual decisions make the overall crisis worse? This matters because private markets are no longer small. The Bank of England says private equity-backed companies account for up to 15% of total UK corporate debt and around 10% of private sector employment, more than 2 million jobs. And these companies are heavily dependent on alternative forms of finance: private credit, leveraged loans, high-yield bonds. Together, these forms of finance make up more than 80% of the debt of private equity-backed UK companies. For the UK economy, that is a significant connection, because if companies cannot refinance their debt, the consequences may not remain inside the financial industry. They can affect investment, hiring, wages, suppliers, and ultimately economic growth.
But there is an important reason why private credit became so popular in the first place. Traditional banks are not perfect. A bank may take months to approve a loan. It may demand strict conditions, and it may decide that a company is simply too risky. A private lender can sometimes move faster. It can negotiate directly with the company. It can design a loan around the specific situation. For many businesses, this flexibility is extremely valuable, and private markets can provide long-term capital that traditional banks may not. So the story is not simply private credit is bad. It isn't. Private credit has helped finance businesses. It has provided companies with another source of capital, and it has allowed investors to earn returns from lending. The real issue is what happens when the system grows faster than our ability to understand it. Because private markets are, by definition, less transparent than public markets. There are fewer publicly traded prices. Less information is available every day, and it can be harder to see exactly where the risk is located.
Now imagine a downturn. A company has borrowed £500 million. Its interest bill rises. Its profits fall. The loan is approaching maturity. The company needs to refinance. At the same time, investors become nervous. They want to reduce risk. But the private credit fund cannot sell every loan instantly. So it becomes more cautious. It stops making new loans. Other lenders do the same. Companies that need financing suddenly find it more difficult to get. And companies that already have debt may be forced to sell assets, cut investment, or restructure. This is how financial stress can spread, not necessarily through one giant bank collapsing overnight, but through thousands of individual decisions. A lender becomes more cautious.
A company delays investment. Another company cannot refinance. A private equity deal is postponed. A bank reduces its exposure. And slowly, credit becomes harder to obtain. The financial system may not suddenly stop. It may simply become more expensive, more restrictive, and more fragile.
This is exactly why the Bank of England is running a system-wide scenario. The exercise includes private markets, banks, non-bank financial institutions, and other parts of the credit system. The goal is to understand how their actions interact during a severe downturn, because the biggest risk may not come from one institution. It may come from the connections between them. A pension fund invests in a private credit fund. The fund lends to a company. The company is owned by a private equity firm.
The private equity firm may have financing from a bank. The bank may have relationships with other funds. And suddenly, what looked like separate pieces of the financial system are connected. If one part becomes stressed, the others may feel the pressure. So, is private credit the next 2008? Not necessarily. And this distinction is important. Private credit is not the same as the mortgage market that caused the global financial crisis. The structure is different, the risks are different, and private credit funds do not operate exactly like banks. In some ways, the long-term structure of private funds can actually reduce the risk of a sudden run. But that does not mean the system is risk-free. The market has grown rapidly. The data is incomplete. The loans are difficult to trade. And a large amount of corporate debt will eventually need to be refinanced. The Bank of England's own stress testing exercise exists because policymakers want to understand what happens under severe pressure. That does not mean the bank expects a collapse. It means the system has become important enough that regulators can no longer afford not to study it.
The strange thing about modern finance is that the biggest risks are often not the ones people can easily see. You can see a bank. You can see a stock price. You can see a government bond yield. But private credit is different. It sits behind companies, behind investment funds, behind pension portfolios, behind insurance companies, and behind the debt that allows businesses to keep operating. For years, the system worked quietly. Money flowed in, companies borrowed, investors collected interest, and the market grew. But the real test of any debt market does not come when money is easy. It comes when the money stops flowing, when companies need to refinance, when investors want liquidity, when asset prices fall, and when everyone discovers at the same time that the exit is much narrower than the entrance. The $2 trillion private credit market may not be the next financial crisis, but it has become too large, too connected, and too important to remain invisible. And the next major test of the financial system may not begin in a bank. It may begin somewhere much harder to see. Because in modern finance, the biggest risks aren't always the ones we can see. Sometimes they're hidden inside the connections between money, debt, and the institutions that depend on them. And that is exactly what makes private credit so difficult to ignore. The money is everywhere. The risk is harder to see. If you want to understand the hidden systems shaping the global economy, subscribe.